Yeah, you gotta do what you think.
Good morning, Ray.
That was traumatic for everybody, because Gina was very beloved. She did the advantage of that already. Out of it. You know, it's not that, it's not doing anything.
Was in the newsletter last night, you know, when I was on the
You know, you all cry about it. No, I didn't know that.
I shared it. This letter was like, Good morning. On your computer, that, he's on your.
Oh, it's like. Yes, yeah, it's right.
Yeah.
We are the big. No. Yeah, they recognize it.
Whatever.
Thank you. Oh, yeah, you want to do something about it. You know, these are good people. You know, so we will all probably see each other and I always say that. I said, you know, see each other. That didn't have to work. Okay, so you're doing way better. I'm so glad you did that. Cool.
See how much about it, because it's not how it was.
Yeah.
Yeah. So it's intersection. It's all like not applied.
Okay. Probably. Definitely, who's here, might get questions.
Oh. Well.
So then my glasses on, and I turned around and said, now I'm looking at it.
Yes. But by the same kind, but you know, we get ready to try to, we want to go and see, Chicago.
They give it
We're gonna read it on this, get water, and so we like stuff like that.
Hi, how's it going?
But it would be great, okay? It keeps me up.
I like your shirt, that's fitting.
Oh.
I don't think it would look as good on me. as it does on you.
Work, if I take work away from you, you can stop dead, that's what happened. That's right. Yeah, that's right. Are you going? You don't. Yeah, but no, I'm seeing it in that, yeah, that's. Who cares?
All right, thank you guys for coming, we appreciate it, these are some, exciting products we got coming to the fold. So for those of you guys that do not know, New Res is our parent company that funds all of our loans. They are the fourth biggest, is this what everybody's seeing right here? Is it frozen on Zoom?
I think this is
Whatever, that's what everyone's saying?
Yeah.
I hope so, we'll see. But yeah, so for those of you guys that don't know, New Res is our parent company, they service all our loans. They are the fourth biggest lender in America, so it makes it easier for us to streamline the process of closing, getting the client's first monthly payment set up. We're in contact with them, so it's not getting sold off to a Wells Fargo or a bigger bank that does service other loans where it's confusing where their payments going. And then New Res recently acquired Caliber. And Caliber is the one that has all these products that are coming into the fold. As far as the ITIN product that we have coming soon, which I know is interesting to a lot of you with some borrowers that don't necessarily have social security numbers, but they do have tax ID numbers. And then this foreign national product that has come into the fold. We do already have access to this product, so if you guys have any foreign nationals that are looking to invest in the United States, this would be a huge product for them. And then towards the end, Ashley and I are just kind of going to talk back and forth about our different products and programs. I went through conventional USDA, FHA, VA, and then some of our down payment assistance programs that we're getting later this month, or excuse me, probably in May or later this quarter. So just kind of a refresh on some of the mortgage products and programs we have available. Ashley and I are going to talk them over on, some of the difficulties that we go through on different products, what's going to be easiest for the client, and just kind of giving you guys another refresher or a deeper understanding of some of these products and programs as we talk them over. So if you guys have any questions, feel free to stop me as we go. I want it to kind of be open forum Q&A for you guys to ask questions on all the products and just kind of get a refresher and then learn about some of our new products. So to get started, we'll go over the Foreign National Program, which is huge, as I mentioned, for out of the country investors. Let's see if I can go here. All right, so first off, what is a foreign national? So what kind of borrower is going to qualify for this program and who is eligible for it? So foreign nationals are a person who is not a citizen of the United States. They must have a valid passport and a visa if it is required for U.S. entry. They must reside and work outside of the United States. And they are not lawfully admitted for permanent residency in the United States because, as some of you may know, we can do loans for permanent resident aliens is the correct term. So people that are not fully U.S. citizens yet, but they are waiting on their citizenship or they have a temporary citizenship, we can do loans for them conventionally, as well as FHA, if they do have documentation. But these programs would be for people that do not have any U.S. citizenship. They're not non-permanent or permanent resident aliens. They cannot be on any USA sanctions list. They are not a non-permanent resident, as I just mentioned. EAD is not acceptable, and they cannot have a U.S. social security number.
It will be available to apply for the visa with a loan.
Will they be able to apply for a visa with a loan? I do not believe so. No, that would be a question for maybe Ashley, but I'm not sure how that would go. So we'll get into kind of all the details on this product, but this is basically for overseas investors that are looking to put their money into real estate in the United States. So
Are you asking if it helps them apply for a visa if they have this one? Is that what you are asking? I have no idea the answer to that, but I think to Hunter's point, this is not like a step in necessarily living here. It's for people who live elsewhere and just want to invest in something here. So
So
it
it
would
says
be,
that one of the requirements is to have a visa. So my question was, the only visa that I know of that you could have when you reside outside of the US is a tourist visa. So is that the kind of visa that's
yes,
required?
yes, because what would be
A B.
needed is they would need the tourist visa to come here and sign for closing, obviously. So they have to be able to enter the United States, but they can't have any sort of citizenship. So yes, that would be the visa that they need. But as you're mentioning, I can look into it and see if them, buying a home here would help them get the visa. But I'm not sure if this loan product would have any say in the, I don't believe so, but I can check to see if it would, have any impact on them obtaining.
What is EAB?
That is a good question. When I read through that, I was like, let me look it up real quick, 'cause I knew I had it.
Oh, employment authorization document.
Okay. So yes, EAB, I guess it's employment authorization document. So I guess that's a work visa almost.
Well,
Not a visa.
no, there are
It's
some,
not-
no, there are some countries that have agreements where they can have an EAD, but don't necessarily have a visa. It's like a limited permit.
Okay, got it. So that is not applicable here. So there are OFAC sanctioned countries. Sanction regulations vary significantly by the country. And the following countries are subject to restrictions on certain types of activities as indicated below. This is current as of March 10th. So, Cuba, Iran, North Korea, Russia, and Syria, people from those countries are not going to be applicable for this program just because of certain sanctions that are on those countries, as well as the ones that are listed below. However, on the bottom here, it does say transactions related to activities with specific parties in these countries are prohibited. So anybody in these countries are not going to be able to qualify for this product due to government sanctions, whether it be their country against the United States or vice versa. So if you guys do have someone that wants to qualify for this product, just send me a message. I'll run it by and make sure that they're going to be able to qualify. But most of the people that I believe that we would be speaking with for some of these products, may or may not live in these regions or countries. Credit requirements, so this is featured under our SmartVest only option. So SmartVest is our, non-QM portfolio products, which I do have them listed after these slides as well. We'll kind of get into some of those. The borrower must own their primary residence in their country of origin. And they must have proof that they do own that home in their country of origin. And if the borrower owns United States real estate, a VOM is required. So that would be a verification of mortgage. And that means that the 0 times 30 means they can have no late payments on their mortgage. So they do have to be up to date. They can't have any missing payments on any of their outstanding mortgages in the United States if they want to qualify for this product.
If they don't have a mortgage, what happens?
Then they're all good. We just have to, if they do have a mortgage, they have to verify that they are not late on any payments.
What about in their own country?
They must have a property, but they don't have to have a mortgage. So if they just have the deed or, clear title on the property, then we can make that work. We just have to document that they do have real estate ownership in their country of origin.
And if they do have a mortgage in their primary residence in their country of origin, does it make a difference?
No, it does not make a difference. But if they have a mortgage in the United States, that would make a difference because they have to be up to date with no late payments on that mortgage. Credit scores are not required. This is a big one. There's a lot of people that try to apply that maybe the ITIN product with no social security number that do not have credit. We'll get into that later as well. That product does not require credit either. 3 pieces of credit from the country of origin. So we do not need a letter for this, but we will need a lender name and contact info that we can pass along to our credit agency for verification. So they don't have to have United States credit, but they do have to have credit in their country of origin, and we just have to be able to document that accordingly. Funds to close, so down payment, closing costs and reserves must be in a USA account for a minimum of 60 days. So this is a big one where if this process is going to take place, we need to make sure that they have an account opened up. They get the funds sent over to a US bank account. And they do have those in there for a minimum of 60 days. Yes, so 12 months reserve minimum, meaning that if the monthly payment on the property is $2,000, they need to have $24,000 in the bank. In order to get that for. Not be a gift, no. But this product, so this is gonna be a different one than the ITIN product. So this is really for investors, for foreign nationals, because the minimum, we'll get into it, but the minimum down payment is 30% on this product. So if someone is gonna put 30% down, that's why in hopes they would have 12 months of reserves as well. And like I said, there were gifts not allowed, so they must pass the OFAC sanction search, so those countries that were listed previously, they cannot be from any of those countries. So this-
Hunter, can you put the PowerPoint into presentation mode? We're seeing it in your mode, which shows you the next slide. So the main slide is not full screen.
Yes. Hold on one second. Oh. So you're saying you see where it says slide 6 of 5 right here?
Yeah, but you're in the presenter's mode where you can see what's coming next rather than in the presentation mode where we can see the full screen. It's one of those screens there that underneath there is probably, I don't know what program is this?
This is a PowerPoint, but the reason being is because they had me do it off of my computer. Instead of, how's that?
There you go. Now we're seeing the full screen. Thank you.
Now everybody in here is seeing it as this, so, okay, anyway, but this is, basically just a sample form, so this is kind of for the lender, but I just wanted you guys to kind of see what it looked like for the client, when they are going to be applying. I'm trying to figure out now how I'm gonna go to that spot, but it looks like this. Hold on,
Change the arrow key.
how should I do this?
Just hit the arrow key on your keyboard.
Okay, how is that?
No, you're back into the presenter mode, seeing your version. Like on the far right, on the bottom, you'll see a little image. Or go to the display settings. You can advance slides by hitting the arrow key or usually your space bar. Display slideshow. Yeah. Now just hit the
You
Well,
guys-
right arrow key or the space bar and it should advance. There you go.
Okay, so I just threw in here, that was a sample of the form for the credit reference list, so this will just be through CoreLogic, which is a credit reporting company that we utilize for this product. It'll just have the person fill it out, our info, their info, and then the items to get research, and basically their credit accounts in their other countries. This is what it's gonna look like. But here is kind of the into the weeds of the product. So the Foreign National Program featured within SmartVest, which again is our non-QM portfolio products. So really just the unconventional loan types. The max loan to value is 70%. There's no exception for this. The minimum DSCR is 1.0. And for those of you that don't know what DSCR is, that's debt service coverage ratio. So we have another product that's just like that for, American investors too. So if any of you guys own any real estate and wanted to invest in another property, we'll get into that later. You don't have to show any income for that product. Purchase or rate and term refinance only. So we can refinance people through this product if the interest rates do drop. I feel like that would be a big question for some of these investors. If the rates do drop after they do purchase, we can in fact do a refinance. The minimum loan amount is gonna be $100,000 and the maximum loan amount is gonna be $1 million. First time investors are allowed, which is big, because previous investment history does not need to be verified. For our DSCR product, that is for American investors, we do have to verify rental income and rental history. So this is big, and they may not invest in an LLC, so it does have to be in their personal name. And financing options are fixed, interest only, or ARMs. So with the interest only product or option, this would be very beneficial for people who are trying to see quick cash flow. You can do a 10-year interest only term up front, which means that you're only paying interest on the loan for the first 10 years, nothing towards the principal balance. So with that being said, it allows that person to cash flow more. They can still take advantage of appreciation. And if they're trying to sell it after 10 years, that may be a product for them to look at. But if they're going to hold on to it long term, I wouldn't necessarily recommend to go that route. Thoughts on that? I know you probably.
Yeah.
see those interest only.
Yeah, because it's gonna be a lot more expensive, because with that, if after the 10 years, it's then 30 years, they mortgage, right? So it's like 40 years worth of interest. And remember, interest accrues based off the outstanding principal balance. So if you have 10 years of interest only, you pay 10 years worth of interest and move your principal balance exactly zero. So to Hunter's point, if it's someone who just wants cash flow for a few years, that could end up making sense. But for a lot of people, they hear, oh, interest only, that sounds great, and they don't think all the way through what that means financially for. So as long as they understand it, I think it's fine, but it will be more expensive.
Yeah, so my only thoughts on that is if they're buying $1 million property, they have to put 30% down, so therefore the loan amount's 700,000. So your loan amount is still gonna be 700,000 after 10 years because you are not paying any of the principal balance down. But if that home appreciates to, $1.3 million over that 10-year period, then they could sell it and make that $600,000 or $300,000 profit off of the investment, and be cash flowing while they're holding on to the loan for those 10 years. So it's really just dependent on what they're looking to do. And then the prepayment penalty options are ranging from 0 to 3 years. So, if somebody wants to make a principal reduction payment, they can do so. But there are penalties from 0 to 3 years. There are no mail-away closings, so it requires an approved attorney, title, or escrow rep, which sounds like you guys will be able to close this product. And then a power of attorney closings are not permitted. So if somebody's gonna do this product, they have to be at the closing. There's no ifs, ands, or buts about it. They have to attend, they have to sign, and I think you guys can close these deals, correct?
Yeah, of course. And I think number 9 is important because we're used to seeing almost every note, unless there's like a hard money lender, is gonna have no prepayment penalty at all. So the fact that there is a prepayment penalty is something that, I'm sure you would explain when they talk to you, but that's something that's different than what we see most often. That might catch people by surprise, because we really only see that the hard money, or sometimes in a HELOC, there's a prepayment penalty. So that I think is important.
Yeah, you could always refinance and then pay down the principal balance of the loan while you refinance, which is a different way to go about that, but we can get into that on case by case situations, because I don't think that's gonna be brought up too many times. But with that being said, so I did want to touch on our ITIN products because that kind of rolls into the same thing. So for foreign nationals who may live in the United States, they may not have a social security number, they may not have credit, but they may have, a business that they run and they want to buy a home. So we do have a product that is coming in Q2 of this year, so it should be here by the end of June at the latest. We were told mid-May, but I also don't want to promise that coming too early and us not have it. So I'm gonna get more information on these products. I know that the down payment percentages are gonna range. I've seen ITIN products with as little as 3.5% down, all the way to 20% down. I'm not sure what we are gonna have available, but I'm trying to dig in deeper to it to get more information, to see what we need for these clients. And then the products are for individuals who do not have a U.S. Social Security number, they do not have credit, and they do not have U.S. citizenship. So these will be tax ID loans that are going to be a little bit more difficult to originate. However, we're very excited to have these products because I know that there are a lot of clients, especially in the Peachtree Corners, Norcross area, and especially with, all the agents in our office that do work on these products that we just don't have available. We wanted to make sure that we could service them for you guys if we needed to. So I'll get more information on them. I know you guys are probably gonna want more, so I'll send out a flyer to anybody that wants more information on the ITIN products. And then, would you kind of touch on what you've seen as far as the ITIN products closing in your office thus far?
Yeah, I mean, for the most part, they run just like any other closing. So from our viewpoint, it's not a huge difference. I think from the information that the lender needs, that's gonna vary a little bit. Right, but as far as what the closing looks like, it really ends up closing the exact same. We still need to have some form of ID. And the reason we ask for that is the same as every other closing. We wanna make sure names are spelled right before people show up. And especially with programs like these types of programs, I know Michelle knows with the last name variety, right? Sometimes you use multiple last names, sometimes there's just one. So making sure we have all of the correct names is really important, especially for these products. So I would say really the biggest difference for us is a higher priority on getting that ID, so we're not changing things at the table.
What kind of IDs
We can accept any government issued photo ID. So like if they're coming from Mexico and they have a Mexican passport, that's perfect, because it's government issued. So it doesn't have to be a driver's license, it doesn't have to be a US passport, just government issued photo and current, it can be expired. Yeah, yeah, because I mean, I could hand you, my sister's social security card, and how would you know the difference? You
What
know?
about those, like, they have these like, I guess it'd be okay, those international like driver's license, have you seen that before?
Yes, also government issued,
It's
so
okay.
that would be fine, yeah, for our purposes. Now, I don't know what y'all
It's the same.
require, saying, okay, yeah, as long as a governmental entity has issued this ID. And there is an expiration date, so we know it's current, and there's a photo, that's good for us.
That expiration date can be a little tricky sometimes.
Well, most have it. I think the only one that doesn't have it is like a gun permit. Which if we're in a real pickle, I mean, the government issued it, there's a photo, so I've had that as like a name confirmation ID, but most of the time, seeing that it's current.
Yeah, and that same cost, so I think it's pretty standard and it's gonna be non-QM, so I think it'll be probably a 30-day closing period. Which is not too extensive, but it is gonna be a little bit longer than our normal closing timeframes. So a lot of these non-QM products are out of our hands, so that they're portfolio products where we're working on them, but there are underwriting guidelines that have to be done by our corporate office. So that does just throw another step in it, so we just need to make sure that we're managing expectations with any of these products that may be a little bit longer of a closing time frame, but I'm sure that as we get going and start originating these, it will get quicker as we go, but to kind of start off with, I would say that 30 days is probably a base for how quickly we can close these. And then Michelle, have you done one of these? You have, is that kind of what you saw standard from another lender? Is that, okay? Just try to see, because I'm hoping we can get as competitive as possible with these products, especially because other people can offer them too, so we shall see how they change. And then this kind of goes into our smart series. So, the DSCR loans that I talked about earlier, these can be used by anyone. So these are for non-conventional purposes for 1099 employees, for investors. I think we've closed a couple of these with you guys over the years. But basically what it is, this is one that I like to share, with a lot of people, is the 12 and 24-month bank statement loans. So these are for, people that run their own business. They may not be able to show as much income on their tax returns as they do in deposits into their bank account. So if someone is receiving, $15,000 a month into their bank account, and they can show that on a 12-month period, even if it's not shown on their tax returns, we can utilize that as their qualifying income. There are other ways as well, that if they have a lump sum of assets in their account, like let's say there's, $750,000 in the bank account, but they're not receiving income, we can use that asset statement and pull income from that to get it to the borrower to qualify for the loan. So it's really a case by case basis. I just wanted to touch on this because it is very important. If you do have a client that maybe is retired and they're receiving social security income, but they have a, bank account with $750,000 in it, we can pull assets from that, add to the social security income, and hopefully try to help qualify them.
With disability,
We use that for conventional loans, actually. So any disability, social security, pension, annuities, child support, that is all used for qualifying income. So that's what we, in our introductory phone call with people, that's what we usually get into is, hey, if they do receive social security, that's when it gets into the other, hey, if you have any pension, disability, and then especially when you're talking to VA clients, like if they get VA disability on top of social security or on top of VA benefits as well, we can always gross that up. So there's a few different ways to go about it. Whenever we have our conversations with clients, we try to ask about that, if we need any more income as well. So we don't have to use it, we won't ask for it, but if we do have to use it, that's kind of when we get into the weeds where, hey, do you have any pension, disability, child support or any of those things, so. And then, so DSCR, these are loans I like to cover these because it's very advantageous for investors like yourself. So these products are investor specific. It has to be for an investment property. It is 25% down for this product and the rate may be a little bit higher. However, you do not have to show any income to qualify for this loan. You just have to have the assets available to put the down payment down. And if you do, then what we would do on this product is we would get an appraisal done on the subject property. When the appraisal is done, for those of you guys that have done the investment properties or gotten a 1008 on your appraisal, that states what the operating fair market rental value of your property is. So if it's a $250,000 purchase price, they may come back and say your fair market value to rent this out is $2,000. And so that would be what the appraiser deems, your property is probably worth to rent out, in regards to comparables in the area, or, any rentals that are close by. And if the operating fair market rental income is $2,000, then your mortgage payment must be $2,000 or less. So that's what the debt service coverage ratio is. And if it's 1-to-1, then we can qualify the loan. So if the monthly mortgage payment is $2,000 and the operating, fair market rental income is $2,000 or greater, that is a 1-to-1 debt coverage service ratio, because the debt is being covered by the mortgage or by the rent.
Does it go into all of the regular, what we just went through? Like, does it go through regular checking, HOA, closing letters, that kind of thing?
Yeah, it will go through most of that stuff, especially if it's like a condo, so we'll have to get that verified, because that's usually on the appraisal side of things, and then for the condo docs. But that's a good question. Let me verify how in-depth they go with some of the, how deep the guidelines go as far as documentation, because that's a good question. You may be able to get around some of those things if they don't have to document that. Because it is not a Fannie Mae, Freddie Mac regulated product, so that could be a way to get around that in the future. But as I mentioned, it is 25% down. You can close this one in an LLC.
Sorry, when we're talking about HOA,
Yeah.
does that count as like the monthly payment, even though it's not escrow, it's not part of the mortgage payment?
Yes, so it will be
But
HOA. So it will be the principal, interest, taxes, insurance, and the HOA, because when they do the appraisal, that is factored into everything. So the HOA will play a part in that, yes. And then these can close in an LLC, and then you only need to verify assets and the coverage ratio over 1-to-1 in order to close this loan. So, like I said, you don't have to show any operating income. You just get the DSCR covered by the appraisal. And then the one thing that I will say is this product is not for first-time home buyers. I had a friend that is a real estate agent in Alabama. He wanted to get, looking on some investment properties. He tried to look into this one. We found out through the guidelines, you cannot be a first-time home buyer. So at that point, if you're going to add a cosigner, it might be better to just go regular conventional, just because of the interest rates. But interest rates on this were not horrible. I've heard some people talk about these products where they get into 11, 12, 13% range. Ours was around 9. So that's when the rates were a little bit higher a couple weeks ago. So not too far off some of the conventional rates, but it is a little bit higher. All right, well, this is kind of where I wanted to just reflect on conventional loans, because I know we went through the foreign national product and ITIN. I figured I would just go through some of our products, talk to you about creative ways, getting people to the closing table, because we've experienced some wild things in the past several months with the market, with seller concessions, different things that may have caused people to have a hiccup in the closing process. I just kind of wanted to touch on those things with Ashley as we go through the rest of our conventional products. So conventional loans, 620 or above credit score, as you guys know. So one of the interesting things that we have highlighted at team meeting, which I think is important to talk about, is not only do first-time home buyers have the ability to put 3% down, but any repeat home buyer that makes less than $76,500 a year can put 3% down, which I think is very important. So if they're below that income limit, we can qualify them for the Home Possible or Home Ready program, which is 3% down. It is cheaper mortgage insurance, and it does help them streamline the process to the closing table by, if we went Home Possible, we only have to use 0.5% of their student loans. So I really think it's important that maybe if they talk to somebody and they couldn't qualify, let us take a second look at it, because if we utilize these products, the Home Ready and Home Possible interest rates are almost a whole half point lower than the regular conforming rates. which so we're at 6.5, this product is at 6%. So not only does it allow people to qualify with lower income, it also allows them to get a better interest rate, lower mortgage insurance, which then lowers their debt to income ratio, which could allow us to qualify someone who may have talked to another lender, gotten quoted at a regular conforming 30-year fixed rate, and we may be able to get the debt to income ratio down to qualify them. So even if we don't get the first shot at it, just an opportunity to talk to somebody in this situation, especially if their debt to income ratio is close. Maybe they need to pay off a credit card, they don't have the means to do so. Well, this product would be great to try to qualify them for, because it may help them get into a home sooner rather than later. Obviously, we have 5% down options for all borrowers. That's kind of standard. If you're buying your second home, you can put as little as, if it's a second home, it's 10% down. But if you're selling your current primary, buying a new one, you can put 5% down, save the liquidity from, the sale of your other home, or put down as much as you want. As I'm sure you guys know, at this point, mortgage insurance canceled at 80% loan to value. This has been a big thing now because I have a lot of clients asking, when can I cancel? When can I cancel? So if your client is aware of where their loan balance is, they can call the servicer, who is NewRez, which is our parent company, and they can cancel the mortgage insurance at 80% loan to value. If your client does not pay any attention, they don't really care, it cancels when it cancels, it will be automatically canceled at 78%. That is required by law. There is no paying mortgage insurance on a conventional loan below 78%. But there is a 2-year seasoning period to cancel mortgage insurance if they do not refinance. And what I mean by that is, let's say you have a client who is buying a $360,000 house and they are putting $60,000 down. So their loan amount is $300,000. That is 83.3% loan to value. So if they are at 83.3% loan to value, they have to wait 2 years in order to order an appraisal to cancel the mortgage insurance, unless they make a principal reduction payment to lower the loan to value below 80%. Does that make sense?
It'll take 1 minute.
So you
I have
can't
to
use
figure that out.
appreciation, is what you're saying,
You
they can't, you
You can.
cannot, unless you make a payment into the principal directly.
No,
If
so
you
you
cannot
can
wait.
use appreciation, but you have to wait 2 years.
Right,
Yes,
if
and
you
then,
wanna do it before 2 years, only if you make a payment to principal to actually get to 80%.
correct, but then if you do not do that, then you can wait 2 years. And so let's say this client's waited 2 years, their principal balance is paid from 300,000 to, let's just call it 298, because if you pay heavy interest up front, and then as it amortizes, you pay more principal going forward. So let's say their loan balance is at 298 and the property appreciates to $390,000 after 2 years, because times are getting crazy, we're bidding over asking price, and they get an appraisal, they can then cancel the mortgage insurance at that point. But they do have to wait 2 years in order to cancel it. And then some of the scenarios, it may be more advantageous for a borrower to go FHA and refinance into a conventional loan. I thought this was big because I had a lot of clients that are in the 640, 650, 660, 670 credit range with some of the FHA loan level price adjustments that they've made recently to mortgage insurance, which I'm sure you all saw, it went from 0.85 to 0.55 is the factor. And then some of the loan level pricing adjustments on interest rates. Sometimes it's more advantageous and cheaper for the client to go with an FHA loan. So I just wanted to put that out there that FHA loans, for whatever reason, have some sort of bad stigma with a lot of people that I talk to. They're like, I don't want to go FHA, I don't want to do that. It's like, if it's the best way to get you into a home and it's the cheapest, I think that the stigma around an FHA loan should be changed, because it is a great product and a great program, especially if you're planning to refinance out of that before you get to 80% loan to value, because on both conventional and FHA, we have mortgage insurance, but for FHA, there is an upfront premium and mortgage insurance is required throughout the life of the loan. So instead of it canceling at 80% or 78% loan to value, mortgage insurance is required through the life of the loan until they refinance.
And I think with mortgage insurance, it's important to point out 78% to 80% doesn't sound like much of a gap. Like, why would you spend the effort doing that? But really for people, it's actually 10 to 12 months worth if they're making their payment. So if you've got $100 mortgage insurance payment every month, and you can save a year of that, that's $1,200. That's worth it for people. So it sounds like a small gap, but the amount of time it takes to clear that gap is larger than you think. So for conventional, obviously FHA, when it runs the life of the loan, it's not an option, but for conventional, it's worth it to request it. If you renew.
Yeah, and I will say, one of the hacks that like, I probably shouldn't say, because I'm a loan officer for a company that services mortgages, but if you pay your loan bi-weekly instead of paying it monthly, you can shave 6 years off of your mortgage. So if you pay, you know, if you pay half your mortgage payments every 2 weeks, instead of paying a full payment every month, you shave 6 years off of your loan term. So instead of a 30-year fixed mortgage, that mortgage is now 24 years. You're gonna save, depending on the loan amount, probably tens, even hundreds of $1,000s in interest by shaving 6 years off the loan. So if you have the means to do so, or you have an investment property and you can do that, I think it's very, you know, it's advantageous to do so. And then if you're the agent or the lender that tells your client to do that, they go ahead and do so, and it saves them a ton of money and time, and it allows them to free some stuff up. And not only are they gonna call you again to buy another house, or, you know, whatever the case may be, whenever they have real estate needs, but it's just a great tip to throw out there to any clients that you have.
And if you pay it bi-weekly and on each one of those payments, you add $50,
And it's gonna be 20 years, yeah.
it's even more dramatic. It's great.
Yeah,
I will say, make
But it's
sure
hard.
when you're telling your clients about this, to talk to the loan officer, because not all lenders allow that.
Yeah.
So some, you know, you don't want to say, oh, you can absolutely do this, set your client up to pay like essentially partial payments bi-weekly, and then set them up to get in trouble with their lender. So have them talk to the loan officer, make sure they set it up correctly.
yeah, and then I was gonna say through our portal, it's pretty easy to go ahead and do
So let
that.
me ask you a question. Is there a certain amount of time, say from when you get your loan? Like say you have an FHA loan,
Mhm.
and then. And you did that because your credit was lower or whatever reason, right? And you needed to get the FHA. Is there a certain amount of time you need to wait? That you say to wait to refinance maybe into even a conventional loan?
Perfect question, because I got that on the next slide.
Okay, because I have that, two people like that.
Yeah, I was gonna say, so right here, my last slide, or last bullet point on here, so if you're refinancing from a conventional loan to a conventional loan, so right now this is huge. As I mentioned, we have the initiative, if you have a client that buys a house and closes with us by June 30th, then they can do I don't wanna say free, we will waive the lender fees on a refinance all the way up until December 31st of 2020 or 2024. So they have 18 months from June 30th to refinance and waive the lender fees. So with a conventional loan, New Res has just come out with a new thing. It used to be a 6-month waiting period, but if you close the loan tomorrow, April 18th, your first mortgage payment is due June 1st. You make your June 1st payment and you make your July 1st payment, and you can refinance after that. So it's gonna be 2 months from conventional to conventional. So
Yeah,
that's FHA's, on the next slide, I'll go into that, but from conventional to conventional is 2 months. So if you have people that are like, these interest rates are crazy, I'm gonna wait till the end of the year to buy a house, share that with them, let them buy a house now, get whatever appreciation is gonna happen from now to the end of the year. And hopefully when we see rates drop down, they can refinance and let them know, not only are we gonna waive the lender fees on the refinance, they are refunded their initial escrow or whatever is left in their escrow account when they refinance, because it's their money. I always make sure to let the clients know your cash to close looks higher, but you're preloading your own account essentially. They are refunded with their escrow account. They'll receive a check back from the servicer. They will then have to reload their new escrow account. They'll be basically reimbursed the exact same amount, so that kind of is obsolete and cancels out. And then the lender for the attorney fees, which are relatively cheap, can be rolled into the loan
I
amount.
was just about to ask that.
Yeah, so there's no out of pocket costs for a refinance with us.
An appraisal.
So you don't,
Appraisal?
you don't have to do an appraisal to refinance. If you do a streamlined refinance, but if you want to waive mortgage insurance because you think you're underneath the 80% loan to value, then you would need to pay the $525 for an appraisal. And that's kind of the only added fee that you pay out of pocket, because obviously no home inspection if you're currently living there or own the rental property. And then, you know, we can do those very quickly as well. So especially if we've done the purchase, it's very easy for us to just streamline and do the refinance. So we'll hopefully be seeing several refinances, well, more than several, a ton of refinances here soon by the end of the year, because that means interest rates will probably drop down below 6 and into the 5% range. You have anything to add on that?
No, I think that's perfect.
What did you say the name of the programs were for the lower income, 76,500 or less?
So they're called Home Ready is Fannie Mae and Home Possible is Freddie Mac. And so the only two differences between those is Fannie Mae guidelines. If you have student loans, I have to use a full percent of the balance. So if your student loan is $20,000 balance, your monthly liability for us is $200. For Freddie Mac, if your balance is 20,000, then your monthly liability is 100 because we use 0.5%. So it really just depends. And then the underwriting guidelines are different. So when we go through and we run the automatic underwriting system, if I can waive, instead of getting 2 months of assets and one of them only makes me get 1 month of assets, it's really whatever is the least document intensive. If there's no student loans, if there's student loans, I'm almost always going Home Possible because when the DTI is lower, MI is lower, it just helps the file. So we're just trying to do whatever's in the client's best interest to get whatever loan level price adjustments we can and get their interest rate as low as possible to help with the monthly payment.
I will say, as far as like low income buyers, something to be aware of that these guys don't do, but there are loan officers out there that to make the transaction look cheaper, they'll quote the basic title insurance policy. And they'll, call us and say, hey, we need you to change title insurance from enhanced to basic. Enhanced is way too expensive. Don't fall for that. Okay, that to me is a little bit predatory. The contract says both us and the lender are gonna quote the enhanced title insurance policy. So they shouldn't be doing that anyway. But they will do that to try to make it look cheaper. Your basic title insurance policy is gonna be a little bit cheaper and have 8 coverages, where the enhanced has 30 coverages. So it's a huge coverage difference for a small cost difference. And just be careful of loan officers who will quote basic. If you think, oh, that title insurance looks low, maybe ask the question, hey, is that an enhanced policy? And don't let them talk your client into not needing the enhanced. Because you hear like all those LifeLock commercials, which you don't need LifeLock if you have enhanced title insurance, because that covers forgeries. Your basic policy is not gonna cover that. So really what they want is the enhanced policy. So just be careful. I've been seeing a little bit of a rise in that lately. And certainly if you have a client who wants basic, we can absolutely issue that. We just need to have a conversation with them to explain the difference, and we'll have them sign a waiver at closing. So we can. It just bothers me that lenders are suggesting this when they really shouldn't be.
That's funny that you said that, because tomorrow at team meeting, we have an example of a quote that I sent somebody on Thursday and a quote that another lender sent them. And our cash to close is like $15,000 off, and our rate is almost a whole half point better. So I'll show you kind of what people are sending out, different discrepancies that they send, and how people are either, sending out pretty crazy quotes, or there are some quotes that are sent out that are not 100% accurate, and there's really ways to see those. So even if we're not working with a client, if you guys want us to read through a quote and see if it looks like it makes sense, we're more than happy to, because if we read through it and it doesn't make sense, that's a good opportunity for us. So if there's anything we can ever check on, we'd love to. And then again, after speaking about that, I'll hit on it again. Do you have any clients looking at new construction? Builders love to sell $500,000 houses, say, hey, we'll give you $5,000 towards closing costs, because you need to work with our preferred lender. And then the preferred lender on top of that will charge a 1% origination fee. Well, 1% of 500,000 is $5,000. They're just canceling out the exact credit they gave to the client, and they're making it look like, oh my goodness, we're doing this great thing, giving you $5,000, but we're just gonna charge it right back to you. So there's really no incentive there. They make it look really good up front to work with the builder's preferred lender, and then they'll charge it back in the back end. So we do not charge an origination fee. A lot of lenders do. We service our own loans, so we don't have to charge an origination fee, because we're gonna make money on the 30-year term of the loan. We don't need any more money up front, so it allows our cash to close to be very competitive and very, very low. So
And discount points are another kind of predatory thing. Like I closed one a couple weeks ago, I think it was like $30,000 worth of discount points that they paid. Yeah, ouch is right. And so, to Hunter's point, when you're comparing different quotes, If they're like an eighth of a point higher, but no discount points. And the other lender is an eighth of a point lower, but they're charging $15,000 discount points. Well, really, they might even be cheaper. So the quote in its completeness is gonna be a lot more relevant than the rate.
Well, and also the sad thing about somebody paying $30,000 for points is they're never gonna recoup that investment ever. Again, I'm not even recommending people buying on the rate. You know, very far right now, because with what the market is right now, and this is just for y'all's information, if you're ever talking to another lender, you have a client asking you questions about this. What we like to do is we give a break-even point. So let's say their par rate paying 0 discount points is 6.5. And they want to get to 6.25, but it's gonna cost them $4,000 to go from 6.5 to 6.25, and it's gonna save them $50 a month. Well, if they have to pay $4,000 to save $50 a month, it's gonna take 80 months to recoup that investment. If you plan on refinancing within the next 6.5 years, there is no reason to do that, because you're never gonna make your money back, because you have to live in the home for 80 months at that interest rate, or you're not gonna recoup that investment. So it's called the break-even point, and we'll just send that to the client and say, here's how many months it's gonna take you. You know, if it's 12 or less, then maybe it makes sense, because it's gonna save them money, and they're gonna recoup that investment before they refinance. But if it's any longer than 12 to 18 months, I'm always recommending do not do that, because we do believe the market is going to move in our favor in the next several months. And so if it does, and that person refinances before that, they're gonna lose thousands of dollars if they divide on the interest rate. So just be careful what people are telling the clients, because buying down the interest rate does nothing for me, does nothing for Ashley. It makes our company no more money by people doing that. It's like the same thing, but it's these people thinking that they're gonna save money over time, and they're probably not. And it also just makes that other lender be able to say, oh, well, I suppose someone else with a 5.25 interest rate. Well, yeah, they paid $30,000.
Yeah.
So, for FHA, just kind of brief recap, 3.5% down, up on mortgage insurance, like I mentioned, is rolled into the loan amount, the premium is. And the insurance is required through the life of the loan. Fees we can do down to 580 credit score. Now with 580 credit score, we may have to put 5% down, we may have to put 10% down, we may have to have some reserves. It really is going to depend on some of the other factors of the person's file, but 580 is doable. There just needs to be some work done to the file, and the customer is going to have to work with us on different things. It may not be able to go 3.5% down at 580. So 6% seller concessions are allowed. I think that's a big thing on these, because you know, even if you're at a $200,000 loan amount, or $200,000 purchase price, 6% of that is $12,000. That's way more than the cash to close is going to be. So if you do get that, we're allocating the rest of that towards the buy down, and it's free for the buyer. So therefore, it makes a ton of sense to do it that way, because they're saving money on their monthly payment, and it's being paid for by the seller. So it's not coming out of their pocket, and all their closing costs are covered. So on that $200,000 purchase, all they need to have is $7,000.
But keep that in mind, because I have had some people exceeding that recently. You know, like if you're applying your commission, like if you're the buyer, right, and you're getting commission, applying that, you might hit that 6% quicker than you think. Or if you think the entire house needs windows replaced, and so it's like, well, let me just give a concession for that instead. Now all of a sudden it's $20,000 to replace the 20 windows in the house. Now all of a sudden you hit that. So keep that in mind and be knowledgeable about that and what you're asking the seller to pay for, and what the seller's offering to pay for. Because most of the time, you're like, okay, that's great, I'll have the money, and then I get to pick the windows that are in the house. So that makes sense until all of a sudden you can't take all that money. So before you sign the amendment early on in the process, talk to the lender about how close you are to hitting that percentage, how much room there is in the loan. Not only for FHA, but all of those. There's going to be seller concession caps on all of them. And what they mean by seller concession is amounts paid on behalf of buyer. So commission counts towards that same amount. It's not strictly from the seller.
And for conventional loans, it's different for the different down payment percentages. So if you put anywhere from 3 to 5% down, you can get 3% seller concessions. Anywhere from 5 to 10, you can get, or it's 2, 4, 6. So you can get 2%, and then from 5 to 10, you get 4%, and then 10 or more down, you get 6%. So just be careful. And then if you are going to get a ton of seller concessions, because there's things that you're doing, make sure when you're, getting the concessions, if you're gonna lower the purchase price too, that you factor that in. If you go from 210 to 200,000, your 6% goes from 12,600 to 12,000. So just keep that in mind whenever you're doing those calculations.
And the way, just real quick, the way around that, if the seller needs to make a repair, is just having the seller pay the vendor directly. Because that does not count towards that percentage, because it's not money that's going to the borrower or to, on the borrower's behalf.
Just
So you
pay
got-
that close.
Yeah, you have the $20,000 window, get the quote to say, seller to pay Windows RS $20,000 at closing. And then you still have your full 6% to deal with.
That's why we got a team here, so you guys have any questions on that, call us, we'll be able to help you put together a good, because I had somebody do that for a new roof. a couple closings ago.
Yeah.
So, these we can utilize DPA, so down payment assistance, I'm gonna go through that briefly in a minute. One of the things I wanted to touch on, that I think is very advantageous, I kind of wish I did this myself. But you can buy a duplex, triplex, or 4-unit property with 3.5% down, and you, as an owner occupant, can put 3.5% down and rent out all 3 other rooms to roommates who are gonna pay for your mortgage payment. All you're responsible is the 3.5% down payment. So if you guys know anyone who's 22, 23, 24, 25, trying to get very ahead, buy a property, they can receive a gift from their parents, family member, relative to buy the home if they need it. But that at $500,000, your down payment on this property is gonna be right around, I think, $17,250, if I'm doing mental math correctly. Yeah, I'm just 3.5. That's a tough one, but I think it's 17,250, to buy a $500,000 property and then rent it out to 3 roommates who are gonna pay for the mortgage payment. I think it makes a ton of sense if you can find a property, that makes sense. And then I've seen a ton in Alabama. I saw a multifamily 4-unit in Alabama last week was listed for like $250,000. Like you can rent that out for $1,000 a room, which is relatively cheap for rent, cover almost double your mortgage payment. So.
Kitchen, 4-unit. Like a, okay. Okay, yeah.
That's the highest we can go for renting. So
Okay.
4-unit is the most we can do for residential real estate. But I think this is huge and very, very advantageous to put you way ahead, as a, younger investor.
Is there a limit on how many investment loans a person has, regardless of whether it's FHA, conventional, or mix, or whatever?
Usually it's about 10. It depends on the servicer of the loan. It's either 6 or 10.
And
Depending
what
on
happens, so what do you do after that?
what claim it's to it. Then it's not your personal stuff.
It's like there's always a way around.
But the loan would.
But wait, a lot of things.
That's a good question, actually. There's 10. I don't know, usually, I have never run into that, but usually what it is it's about 10 loans for a conventional, so we can do the DSCR loan. But usually for the 10 conventional loans or FHA conventional, it's usually about capped at 10, I don't know.
Is it loans or properties? So what you could do if it's truly loans.
It's loans.
So what you could theoretically do is refinance multiple properties under one loan. So you have one loan with 3 pieces of collateral. Now, I don't know if y'all would consider that like a commercial loan.
We don't do blanket loans, that's just
Okay.
what that would be called. So let me find out more information. That's a great question. I should have that answered. I can figure that out.
I've never heard of a blanket one.
Yeah, so blanket loans would be like several units that you can do with one loan. That would probably be more commercial. But yeah, there are blanket ones because I've looked at trying to do one for somebody at a previous company. So
And sometimes they're called like cross collateralization loans. Cause it's a mouthful, but you just have multiple pieces of collateral.
Yep.
Under the one.
Because I've been listening lately to somebody to say, okay, leverage your own investment properties to buy more investment properties, so you're already putting like 25% down when you're buying them,
right.
right, for investment, at least 20. So then hold it for a little bit and then get a home equity line of credit on it, get the money out of that one, even if you're at 100%, at that, it doesn't matter, the rent would be
Cash flow,
paying that. And then you can take that money and buy the next one,
From the
and then
bill.
buy the next one,
Yeah.
but there must be some sort of limit.
Yeah, no, that's true. I need to figure that out. That's a good question. It's a good problem to have, though.
And does that count as 2 loans if
I
you
heard
got
about,
the
I
loan
was
and
saying
the
something
HELOC?
about that too.
No,
And I'm
it's
like-
one property. So the HELOC does not count as 10 loans. There's a difference.
Right, but you
Yeah.
still have
I get what
the
you're
loan
saying.
on the
Yeah,
property that you took the HELOC from.
yeah, definitely. That's a good question. I'll have to figure that out as soon as we get out of here. So for FHA as well, can go up to 55% DTI. So that's just a heads up, can go a little bit higher than conventional and VA. VA is usually up to 45 on some, we can get up to 50. These are 100% financed or veteran only. Credit can go as low as 600. I just figured I'd touch on this real quick, so I've actually had several VA applicants lately. And would love to help as many VA borrowers as possible.
I know that for closing purposes, this is the only type of loan that requires a termite inspection. So the VA came out over the summer and said,
Unless it's FHA new construction, I just learned that.
oh, well, yeah, some of the new construction, yeah, good call. But for the resale, I guess you could say, VA requires termite letters. So either the buyer or the seller can pay for that initial inspection. But you want to make sure that you're thinking about that and preparing your client to get to the table, because it's y'all's responsibility as the agent to know, make sure that that termite inspection gets done. And make sure you know who per the contract is supposed to pay for that initial inspection.
And we'll help.
The
with that
check
too.
mark.
Yeah, we'll make sure to help with that as well. Moving on quickly, USDA, I do not see many of these loans, but they really are kind of getting tighter on the ratios. So it's kind of around 35%. These are just rural areas. There's a USDA eligibility matrix online. All you have to do is Google that and it pulls up. You can put in a property address and it shows that it's USDA eligible. If it is, there's several steps we have to go through. There's a little bit longer approval period, but we'd be more than happy to help with these types of loans as well. So I wanted to put that out there. If you have anybody looking rural farm agricultural areas, we can service these loans. It's just a little bit tighter DTI requirements. So if you have any other questions on that, just call me, but it is 100% financing. So it's like, you know, I don't want to relate it to a VA loan because you gotta be better to get that, but it's really the same sort of deal as a VA loan. It's just for rural areas and there's no funding fee. So.
Hey, Hunter, you got a, Hunter?
Yes. Yes.
I'm sorry. Yes, just had a question for you as it related to the VA loans. I see where it said minimum FICO score 600, right?
Yes.
Okay, and so if someone has had like charge-offs or anything like that, do charge-offs, everything has to be paid? And is there a certain period of time that they would
No,
have
so
to be?
They don't all have to be paid. Those are different depending on what type of charge-offs they are.
Okay.
So there's different medical collections and different things like that we are now not having to utilize for qualification, which is a new thing that just came into the fold. So if they want to have a conversation with me, we'd love to talk to them or at least look at the credit report, and
Sure.
see what we can do. Because a lot of the charge-offs, we just omit, depending on what they are, so.
Awesome, thank you.
Yeah, you got it. And then the last thing before we get out of here, everybody's been asking about down payment assistance. We are getting Chenoa, which is a great product. Actually, I know you know a little bit about that. And then Click to Close. So these are two products that we have coming in Q2. Again, they probably should come with the ITIN product. But we will have these available. Usually these are paired with FHA loans, because of I guess maybe because they're assumable.
Yeah, well, there's also like qualification requirements, so you can't make a whole lot of money and qualify for down payment assistance just because you don't want to come up with that down payment money. You have to really have a need for that down payment assistance. So I think that's why we see them mostly with FHA, is because most of the buyers who really need the assistance are tending to go FHA.
Yes. And then also with these products, I would expect a longer closing time frame. I try to steer people away if they don't have to go this route, because it's hard to win offers. Because not only does shelter have to go through, we have to qualify the loan, fully underwrite it, but as soon as we're clear to close, then we have to ship it off to whatever company is originating the down payment assistance. They have their own conditions, they have their own underwriting. We don't know their turn times, and we are not in contact with them directly. We have to wait for them to basically reach out to us and say it's done. There's nothing we can do to expedite the process. So once it's clear to close at shelter, it could be anywhere from 2 to 3 weeks before we close this loan due to their underwriting turn time. So we're just gonna have to make sure all parties are, understanding that it is gonna take a little bit longer, and we do have to reach out to them to make sure that we're clear to close with the down payment assistance.
Yeah, and your buyers need to understand that it's actually a second loan. It's not like free money, so there's gonna be a second security deed that they sign. So it's like a first and second mortgage. It's not a whole second mortgage signing package, but it is 2 loans. Now, a lot of them are gonna be forgivable, but there are certain qualifications that go along with the forgiveness. So they have to live there for so many years. Most
Usually
of them.
7 years.
Some
Five,
of them, yeah, a lot of them are 5, but these 2 might be 7. So as long as they live there and are on time with their payments for the first mortgage, then they could qualify to have that forgiven. And some of them have like a sliding scale of forgiveness, so a lot of the ones that are 5 years long, you reduce that amount by 20%. So if you've got $5,000 down payment assistance loan, after you live there for 1 year, make all the payments on time, now you only have to pay back 4,000. After the second year, you pay back 3. Some of them are all or nothing, so you have to live there the entire time, and then the whole thing is forgiven. But I say it's so important to make sure your clients understand that it is a loan, because let's say they, get transferred and they're gonna move to Arkansas. And they've only been there for, 18 months in the house. Well, when they sell it, they have 2 mortgages. Okay, so there's gonna be 2 security deeds on title. There's gonna be 2 payoffs on the settlement statement. We have to get a payoff from the second lender, which often is a lot more difficult than getting a standard first mortgage payoff. So those timelines and expectations are important for your client as far as the forgiveness goes. Because almost everyone thinks it's just a free gift and there's no strings attached, and that's not right.
Correct.
Is there like a, if you want to try to get down payment assistance, is there a max, say, price of the house?
Yes,
Or like,
Yes.
what is,
I think it's around 350, but I don't know until we have.
without like a new construction or?
No,
Can,
I'll have to look it up.
you can afford new construction.
Yeah, you're probably not looking at down payment assistance. for your
You
own
surprised people
construction,
ask,
but
people ask that.
But there's definitely limits as far as sales price, income.
The amount, that's why they have their own underwriting guidance.
And did you ever, going back to the FHA, I had that question about that with the mortgage insurance or.
Oh, yes, so 6 months is the seasoning period. So if they close, they have to make 6 monthly
So
payments.
say they close in January, they can't refinance until
July.
July.
Really August, right?
Or August,
Because if it closed in January,
I need to make sure if it's 6 months seasoning from the date of consummation or date of first monthly payment. Because for conventional, they just changed it from 6 months from consummation to 2 months after your first monthly payment. So that's why you
Okay.
refinance a lot sooner. So I think they changed it for FHA from 6 months of your first payment to 6 months of consummation, but I gotta check.
I mean, because that would be a way for them, like if they don't have to have the mortgage insurance anymore, that's pretty much what they have to do to get rid of it
Correct. They have,
before 2 years.
yeah, that's exactly what they have to do to get rid of it, but.
but with FHA, it's for the life of the loan. There is no getting rid of it. You have to finance the loan totally. For FHA, for
Yeah.
conventional. you can
Yeah,
get-
but I'm saying if you're getting if you want to get out of the FHA and refinance into a convention.
All right, well, perfect. Thank you guys for coming. Hope
Thank
you
you.
guys enjoyed and learned something. I'll have more info on the ITIN, down payment assistance and all that good stuff. And Ashley, I always appreciate you. So thank you.
All right.
Business cards.
I do, yes.
All right, then. Gotta make
Thank
some
you.
calls.
Yeah, thank you guys for coming.
Yeah.
Absolutely. Thank you. Do you have any questions? Thank you.
It's I don't want to get dressed. I'm putting this in.
I'll do that. Hey, thank you guys.
You're so welcome.
Thank you, my dear. So sweet.
See y'all later. Have a good night. Thank you. Bye, Ashley.
All right. I got work to do. I know. Crap on my style is important thing. I said, just come on, let's go win the lottery. I'm like, no. That's not gonna work. $1 million really doesn't go very far anymore.
One of the best is the one down. Linda, Beth, me. Spencer. And she come on.